Hi, I'm Justin Struble with BSG Advisors. I want to talk about the stock market and if it's accurately priced, because I get a lot of questions from clients, prospective clients, friends, family saying, can it keep going up? We've got all this pandemic, we've got the election turmoil, we've got politics involved. What's it going to do? Is this just a giant bubble that's going to crash? So I hope this chart that I have behind me will help clear it up a little bit. Let me tell you a little bit about the chart and what we're looking at. This is from 1978 to 2021. 15% interest rates, 10%, 5%, 0, -5. The red lines, I've got the actual data as well as a trend line. Same thing for the green. The red line is 30-year Treasury notes, long-term government-issued bonds. They started in the 10-15% range, and through the 80s, the 90s, 2000s, 2010s, and to today have continually a steady decline. Not always consistent. There's been ups and downs, but downward trend. That's what interest rates have done. Will they keep going? Will we get to zero or negative? That's a conversation for another day. But the green line is what's maybe most relevant to the stock market. Now, a lot of people look at stocks and they talk about the PE ratio, the price to earnings. That means if I get $1 of earnings, the price might, if it's a PE ratio of 20, that means the price is $20. Go buy something for $100 when the PE is 20. 100 divided by 20 is 5. I get $5 of earnings for buying this thing at a PE of 20 at a price of $100. So that's the relationship between the price of a company and the earnings of the company. You can sort of look at this as dividends, although it's not exactly the same. But what I have here on the chart is not the PE number, because I think that's a little bit misleading. What I have is the earnings per price. So flip those over. Instead of saying the price is $100 divided by 20 gives you $5, I flipped it around and said $5 over 100 is 5%. It's the inverse of 20. But it correlates very clearly with interest rates, which is why I put it up here. The earnings per price of the S&P 500 was also 10-15% in the early 80s and declined down. We had the lost decade where stocks were flat for 99 to 2009 through the major 2008-2009 crash, Great Recession. And then we have the 2000s all the way to 2020. So we've got about 42 years here on the chart, and you can see a relative correlation between interest rates, long-term federal treasury notes, and the earnings per price of the S&P 500. Now, I give that to say we're not way out of whack. These are actually very close here at the end. Yes, the earnings per price in the stock market is a little bit higher than the interest rate at the Treasury, but that may or may not make sense to you on why. This here was a great, from the early 80s to the late 90s, was an awesome years for the stock market. The stock market averaged over 15% returns for that period of time. Now, when it does that, when the price of the stock goes up 15%, 20, whatever it went up each year, this earnings per price, when it's still consistently getting lower, means the earnings were going up more than the price was going up, which is a very justifiable rally in stock market. We had a great market because the earnings, the profitability of companies were doing extremely well. Conversely, we had a lost decade where you can say, well, the earnings per price didn't really change much, and the price didn't really change much. That means we didn't really have growth in earnings in the economy, in the stocks that are in the S&P 500 during that decade. Now we look at 2008, 2009 to 2020, the last decade, and we say, all right, we had pretty high earnings per price, and that has steadily declined as you would expect as the price has gone up, which means our price has gone up more than our earnings have because our earnings haven't kept up with the price. But that's acceptable because we still have a earnings per price that's higher than interest rates, whereas historically they've been very similar. So that means at this point we could actually have a rally in prices another 10-20% without any change in interest rates or earnings, and we would still be in line with long-term Treasury notes, which means if the stock market goes up 10%, 20%, you shouldn't blink, you shouldn't panic. It's within an acceptable range. So simply looking at the price or the price to earnings is not a good way of saying, oh, the stock market's overvalued, because you have to compare it to the other stuff. You say it's overvalued, what's it overvalued compared to? Because if you have money to invest, your choices are stick it in the bank and earn nothing, go buy a Treasury note and earn 1 point something percent, or put it in the stock market and earn 2% of earnings and have the upside. The price might go up as well, but also the risk that the price may go down. Long-term investors will typically choose stocks. If you're short-term or conservative, you may go to bonds or hold a cash. But to say the stock market's overvalued simply because the price has gone up is a little oversimplified. I hope this clears up why I'm not worried about the price, the values in the S&P 500, even though that PE ratio is now in the 30s instead of a historical 20s. The historical 20s was when we looked at this decade, or even way back into the early 1900s. You have to compare it to interest rates. Compared to what? The money that's out there, the investment dollars. What are your other options? You have stocks, bonds, cash, or maybe cryptocurrencies or something. But compare it to what is it overvalued? When you compare it to interest rates, stocks are fairly valued. I'm Justin Struble with BSG Advisors. I hope this clears up and gives you a little more comfort in the market. And remember, I'm not a broker, I'm a fixer.